Welcome back to the Property Frontline, and I'm very excited today because I'm here with Alesha Masaud from Tax Accountants. Hello, Alesha.
Hi, Debra. How are you?
Really, really good. Now, accountants are critically important to my clients, whether they're buying homes or investments, and particularly commercial property. And it is so hard to find good accountants who actually understand the nuances of property, let alone give the personal advice and strategy that you and your team do along the way. So I'm very, very grateful that you could take some time out to talk to us today. So I'm going to jump right in. And so to just give us a little bit of an overview, can you tell us a little bit more about what you do and also about TaxApp?
Yeah, for sure. So, I'm a partner at TaxApp Accountants. We service businesses and investors across Australia. We've got two offices, one in Five Dock and one in Lane Cove, both in New South Wales, Sydney area. But our clients are across Australia. The only place we don't have a client is in Tasmania. So so we service across Australia, primarily, like looking after investors and business owners.
Yeah, that's fantastic. And that little app really saves people a bit of sanity, or I shouldn't call it that little app, should I? The tax app itself really helps people understand and manage their approach from a finance perspective, yes?
Yeah, definitely. So primarily, it was kind of born out of a need from um, like people bringing in shoeboxes of
Yeah.
receipts or forgetting to upload things on Excel or in adding information on Excel. So we thought, hey, how about we to build an app that is really easy to use? You can upload your receipts. If you're a property owner, you can add multiple properties in there, and track your expenses, especially if you don't have someone managing your property, because you don't get that beautiful, at the end of the
Summary.
year, you don't get the summary.
Mm.
But then, other than that, it's great for micro businesses and also at the end of the financial year to get your tax return. So, it's a multi-purpose everyday Australian app.
Yeah, it's fantastic. Yeah. Okay. Alrighty. So today we are talking about structure for property buyers, typically investors, but homeowners do need to think about that now as well. So can you explain why structure is so important, particularly in relation to property, and why got to have that conversation before you buy the property?
Yes, it is one of my favorite topics to talk about because I see it get wrong so many times, and then
Yeah.
people always come back and say, "Hey, can we fix this?" And it is one of the most costly mistakes to
Mm.
fix, especially if your property has increased in value over time. Because if you do want to change the ownership structure, you have to pay capital gains tax, which is essentially tax on the money that you've made. So you bought it for 500, you sold it for 600, you have to pay capital gains tax on the $100 or $100,000 on that property.
Mm.
When you to transfer a property, the government says, "Hey, since you are doing this transaction, I'm going to charge you some money for
Mm.
transacting." So you have to pay the government and say, "Here are some of the money that you should keep for letting me own this, I guess, or putting this on my name." So that's stamp duty in simple terms, and yeah, you'd have to pay that twice. So there are
Yeah.
very few instances where it makes sense to change ownership.
Yeah. And there is quite a range, isn't there? So can you tell us about the range of structures that investors in particular could use?
Yeah, definitely. Let's start off with the more easy and then we'll build up to the more complex ones.
Sounds
Um,
good.
so your basic structure is your individual name. So you go in, Joe Bloggs goes in and says, hey, I want to buy this property. And the conveyancer says, who are you going to buy this property? Like who's buying this property? He says Joe Bloggs is buying this property, signs off as Joe Bloggs, done and dusted.
Yep.
Now, if Joe Bloggs also has a Mrs. Bloggs, then you've got a couple of different options. What you can do is you can buy as tenants in common or you can buy as joint tenants. And there is a bit of flexibility in the tenants in common piece where you can sort of go, okay, this person's putting in 30% of the value and they'll only be making 30% of the repayment. So we're going to do like 30, 70, or you can do 50-50, which is usually the case. But in tenants in common, what happens is if someone passes away, you don't automatically get the 50% or the other percentage that goes through the wills and estates system. If they're prepared enough and they've got a will in place, that's fantastic. If they don't, then that's a whole separate issue.
Yeah.
But when you're joint tenants, if something happens to the other party, it automatically transfers to the person who owns the rest of the portion. And now to make things more complex, if Joe Bloggs wants to buy with his brother Bloggs, then he needs to really think about what he wants to do. If he has kids, if he wants to transfer that ownership to his kids down the track, or if he's buying with a partner. So those are some complexities that come into play that then translate to the tax scenario as well. So if you own a property 30%, you only have to pay tax 30% on 30% of it, versus if you own it 50-50, then the tax split would also be 50-50. So yeah, I feel like that was a lot.
Yeah. Yeah. But it is important for people to be able to like think through it because it does come down to income in the end, doesn't it? So, you talked about the couple scenario. So sometimes it might be better for the um, say the female is the biggest income owner, we want to put the property in her name because she'll need more of the deductions. So it just becomes really, well, I wouldn't say complex. It's really just thinking things through. Doesn't have to take forever. And when you think of the money involved, it's really important to speak to someone like you um, to work it all out. Yeah. Okay.
You made such a good point there, because I actually came across a client who um, is in a very similar scenario. So the female is on the highest tax bracket, and the investment property is completely in her name because that provides her with the biggest tax deduction. Whereas the partner, he is on a lower income threshold, also helps, with the kids, running errands, yada, yada. So doesn't make sense for the property to be in his name based off of
Mm,
on the tax basis. So yeah.
yeah. Yeah. It's tricky. Okay. And so you covered off individual names and also joint names. Do you want to talk about trusts?
Yeah.
Um,
So trusts are the most widely talked about, but the least understood, I feel, because I've received a few phone calls from people. They sort of think about, oh, I don't know who's buying my property. Like I put in the name, but when I'm looking at the contract, it doesn't look right. And so people sometimes get like panic a little bit. But trusts are primarily a vehicle. So think of the car that you're driving, and if you want to use a trust, it's a different kind of car. It's a more high-end version compared to your individual or your joint names, where you have to create a family or a discretionary trust. What that does is trust never owns any asset. It only controls the asset. So when it controls the asset, what happens is there are beneficiaries who get the benefit of the asset, but the beneficiaries may or may not control the asset. And at times, we've got a corporate trustee that controls the asset, and that provides the maximum amount of asset protection that you can have in a trust structure. Because at times people say, I want an individual trustee because it's cheaper to set up. But what that does is it doesn't have the same level of asset protection. And asset protection really comes into play when you have built up a bigger property portfolio, you've got large sums, either you're making more money or you've got a higher risk of being sued or things like that. So that comes into play. Uh, but there are some issues when it comes to purchasing a property in trust, and people need to be aware of these elements before they jump into purchasing a property through a trust. And they include things like the fact that you can't negatively gear your property. So all of the negative gearing essentially gets trapped in the trust. It's kind of like you've created a whole new entity, and everything that happens in that entity stays in that entity. And then again, with trusts, some states will have a higher land tax. So
Yeah.
say if you've got a new trust, you're going to start off with the highest land tax. So those are some of the things that people really need to be thinking about if and when they want to consider trust. And trust is more of a mature vehicle to use versus like this is your first property you're buying and you're gonna buy it in a trust. But the fantastic element with trusts is you can distribute income to multiple people, and that is the thing that makes it unique and wonderful.
Yeah, so true. So that scenario you were saying when, if someone like changes their job and all of a sudden um, the male in the, oh, well, could be two males. Anyway, so person one, they get, they increase their income, and person two takes a little bit of time off. If you've got property in your trust, you can redistribute the costs and, control things that way.
Yeah,
With
definitely.
yeah,
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 no, definitely. So, because people normally hold properties for a long period of time. And if that's the
like,
goal, you don't
yeah,
really know what's going to happen 10 years down the track. You can plan for the future, but you can't predict the future. So yeah, and if your family dynamic changes in that period, it's really beneficial to have the flexibility, and trust primarily provides the flexibility. And because it's a discretionary trust that most people purchase their property in, you distribute the income at your discretion, and that's where the name sort of comes from.
yeah. And yeah, trusts can work really, really well, but you just need a really good accountant to work with you. Yeah, okay. And then purchasing in companies.
I really don't recommend that. And the reason why I've got such a strong reaction to that is purchasing a property in a company means you don't get the 50% CGT discount that you do in all of the other structures we talked about. So individual, joint names, tenants in common and joint tenants, as well as trusts. Because effectively, um, when you distribute income to a person, a human, they receive a 50% discount to the money they've earned if they've held the asset for over a year. So not just 365 days, but 366 days you have to hold the asset for to be able to get the discount. And you primarily, if you bought the property for $500,000 and you sold it for $600,000, you have made $100,000 on that property. Now, when you apply the discount, that means that you only have to pay tax on $50,000 and you miss out on that in the when you purchase an asset in the company, but the company does provide great asset protection. So I'll call a spade a spade. It does provide great asset protection, but it doesn't give you good tax discounts. So, which is why we don't necessarily recommend purchasing a property in a company.
Yeah. And so would you, like a lot of people are starting to buy in their SMSF. So where would that sit in this structure conversation? Would
That's
you?
great. That's a great question. So that sits in a trust. And that's a little bit more complicated because you first have to establish your um, trust to hold all of your super fund in. And then when you purchase the property, then you create a bare trust. And that is a special kind of trust you create to be able to get a loan from the bank. And most people get a loan from the bank to purchase a property. Very lucky people don't need to get a loan to purchase a property. Yeah, don't need to get a loan. So what you need to do is you need to set up two trusts when you're purchasing a property in an SMSF. And sometimes people don't recognize the complexity, but essentially it's kind of like an arm's length transaction because
Mm.
it's first of all shielded in your SMSF and then again in another trust, which is the Bear Trust. But effectively, it's holding everything until you retire. So you can't touch that money. You can't even, take the money out of your SMSF bank account to pay for a holiday because that's not appropriate use of your funds. So think of that as very, very separate to you.
Yeah. And so overall, when we're thinking about the different ways to go, can you give us some tips on how to make the decision?
That's a great question. And I think that answer lies in what you want at the end of the day.
Yeah.
So, for someone who is looking at purchasing their first property and they're still single, and they want to buy it in their own name, they're not really wanting to get their parents or their siblings involved, then the individual makes a lot of sense. Now, if you have purchased like 3 or 4 properties or a couple of properties, and now you're more of a seasoned investor, um, and you're wanting to level up a bit more, then a trust makes absolute sense. So, it really depends on what you're wanting to do. Another element is if you've got kids, you're a couple, and they may be turning 18 soon, and you're thinking, okay, I'm going to hold the property for 5, 6 years. My child's going to turn 17, 18, around about that period of time. Then again, it's a really great point to think about a trust because there are some great flexibilities that can come into play then, and especially if you're sending your kids to uni, you're saving money for that. And
Mm.
so, yeah.
Yeah. Yeah. And really just call you is what I would say. Call you and talk it through. All right. So when it comes to thinking about buying property, can you talk to us about some of the ranges of costs involved and the tax implications of those?
That's a great question. So there are two different types of costs when we are purchasing a property. One is where it doesn't get deducted immediately, but there's a long-term benefit.
Yeah.
And one is something that you can deduct immediately. And then there is a hybrid. So imagine the two have a baby, and that is your hybrid cost, which is going to be deducted over a period of time
Mm,
versus being deducted immediately. So let's talk about something that you won't be able to deduct immediately, which is things like your stamp duty, your conveyancing fees, things you do to be able to purchase the property, even your buyer's agent's fees. Um, a lot of people ask me if they are tax deductible, and I say, yes, they are, but not immediately. It's tax deductible once you sell the property. So that's when they get added to the cost base, which is a principle in accounting where you think about, again, our property of $500,000. And then what you do is you add more money to that to say, for example, I paid, let's say $20,000 to a buyer's agent, and then you add $520,000 before you then say, I have made X amount of profit. So it helps you reduce the number, the tax that you have to pay when you sell the property.
mm,
And then the other one is your ongoing costs. So now you've purchased your investment property, you've got a tenant in there, and you've got a manager who's managing the property, you can deduct that immediately. Interest, that is going to go, you can deduct that immediately as well. So
mm.
those are the things that are your ongoing costs, the day-to-day running of your costs, you can deduct them immediately. Now we've got some hybrid costs. So imagine the immediate ones and the long-term costs. They had a baby. So it's called um, depreciation. So what happens
Yeah.
is you deduct those costs over a period of time, and usually it's a 5-year period that you deduct those costs over. And those things are like your LMI, if you have to pay those,
Yeah.
your loan establishment fees, if you ever paid a mortgage broker to get your loan. So those are the kind of things that you'd have to think about. And they get written off over 5 years of purchasing your property.
Mm.
So yeah, it's a little bit complex, but hopefully that helps you or helps the listeners understand what are the different types of deductions you can get when you
Yeah.
get an investment property.
Yeah. And you raise a really good point about depreciation. There's so many people that get trapped, thinking that they're going to have a cash flow positive property using depreciation. And, that's just a recipe for disaster, because if you have to leave your job or take a work break, we have issues with depreciation, don't we? Because you can't depreciate against no income, can you?
Yeah, so you can't, you can still depreciate the property, but you won't be able to get the negative gearing benefit. So you won't be able to get the money back from the tax man if you're not making the same amount of money as you were before.
Yeah, yeah, that's right. Of course, that's right. Like you would know. Yeah. Okay. And what about some of the traps? So the initial repairs trap.
Yeah. So that happens to quite a few of our clients, and has happened to a few of our clients where, for example, where you talked about buying a home where the property is not the newest. So, for example, a 1970s build or a 1960s build, and once you um, get that property, now there are works that need to be done to that property. There are two different ways of thinking about the works. One is your simple handyman repair job. Some tiles are broken and you just have to fix the tiles. And that can be deducted really easily. Whereas if you then go in and replace the whole flooring, that can't be deducted immediately. That becomes part of your cost base, which I was talking about
Yeah.
earlier, where you deduct it once you sell the property because you're upgrading the property. Uh,
Mm.
and anytime you anytime you significantly upgrade a property, you cannot deduct that immediately. The only thing you can do is depreciate that after you get a valuation done,
Great.
but you cannot deduct it immediately. So if you spent $20,000 updating the flooring, therefore you can't say I'm going to write off $20,000 in my tax this year. So that's a
Yeah.
trap that people think that, oh, I'm going to get such a good tax return this year because I spent so much money on my property. It doesn't always happen that way.
Yeah. Um, and like I could be completely getting things mixed up here, but wasn't there? So is this sort of situation where you buy a property and if you do the works, so I guess this is what you're saying, you buy a property, you do the works before you put a tenant in, and then like, does that mean you cannot deduct it, or does it mean that it's still just you still just use it as a capital works deduction?
So when you do put a tenant, before you put a tenant in, if you I think of it as like either getting new jeans or updating your jeans kind of thing. Oh, sorry, fixing your jeans. So if you've got a big rip in your jeans and you're just patching it up, you can definitely claim that. But if you get a brand new pair, if you're updating something completely, then that forms part of capital works. Now, the scenario where the tenant comes in is if you're doing little bits and pieces before a tenant moves in, just like a door handle is broken, to get the property ready for a tenant, that can be deducted immediately. But again, if you are changing the whole door, then you have to rethink about that becomes a capital deduction. But it is a complex topic because
Nuance. Yeah.
it depends on what has been done versus so for example fees to put the property online, and those fees before the tenant moves in are deductible, but some of the work that you do may not be deductible. So
Yeah.
we need to have a chat about that before
Yeah.
you go on like $50,000.
Yeah. I've got a couple at the moment, but yeah, be uh, very long conversation of what we're going to do with them. All right. So the next topic, can you explain a little bit about operating costs versus cash flow?
Yeah, definitely. So, operating expenses are your items that um, you spend on day-to-day stuff. So you have to pay interest every month, and that's a day-to-day expense. You have to pay council rates, water charges, land tax, agent fees. All of those are your operating expenses, and including your insurances like building and contents, landowner insurance, and things like that. And then you also have some cash flow things that come up. And what that means is you'll have to do some big ticket items. Sometimes the hot water system blows up. And then that's going to impact your cash flow scenario. But usually a property that is cash flow positive, for example, you can look at and say all of those things are getting covered off by the money that it is bringing in from the renters. So if you've rented it out and it's getting good, steady rental income, and you're managing the interest and the actually your mortgage payments and everything is cash flow positive, effectively it's washing its own face
Yeah.
effectively.
Yeah.
And yeah, and then sometimes like a big thing happens, and that can be a kind of element that you can think about as an odd scenario. That's happened, doesn't happen on a regular basis. So those are some of the things that you have to think about when you think about operating expenses and cash flow.
Yeah. So kind of like budget for those sorts of things, have a bit of a buffer. Yeah.
Yeah, definitely.
Uh-huh. Okie dokie. Now, you have touched upon this a little bit through our discussion, but when it comes to selling a property, what are the things that property owners need to think about?
Yeah, that's a great point. From a tax perspective, sometimes people don't think about um, how it's going to impact that financial year. So, one of the most important
Right.
things is to hold the property or an asset for more than 12 months, which is 365 days plus 1 day, and then you're good and in the clear to sell the property, and you'll get the 50% discount that we talked about earlier. And what that means is you only have to pay tax on half of the profit. And I see that as such a win-win deal, because when you're making money from your job or through your business, for example, you have to pay tax on the full amount. So if you made $100,000 from working, you'd have to pay tax on the $100,000. But if you make $100,000 from property, because it's gone up in value primarily, that's when you can get the 50% discount and you only have to pay tax on $50,000. Another thing to note is the capital gains tax is looked at the date the contract was signed, not
Yeah,
the day the transaction happens. So usually people get caught out because they say this we're selling on the 1st of June, right? And the 30th of June is the financial year, and they say, okay, we haven't made a lot of money this year. That's great. Or we have made a lot of money that year, actually, I should say. And then the settlement happens the next financial year, which is in July. So let's say 15th of July, the settlement happens. Now, people say, okay, because I've already received money from property this year, I'll try and not take the extra shifts and yada yada. So I will have a lower tax bill in the next year. But actually, your tax is going to get calculated based on the day you exchange contracts and not the day you
settled.
transfer the money. So, yeah.
Yeah, that is such a really good tip. Um, and we see that so often that people get confused about that, because you really want to, not that we're teaching people how to, um, dodge taxes or anything, but you've just got to be mindful about when you do it because, um, if it's going to affect the returns, you want to time it so that you're going to get maximum impact,
Yeah,
correct?
definitely. And then another element that is wonderful is the 6-year rule for your home. So
Oh,
if
yeah.
you own your home and you move away from your home to, for example, I used to live in Adelaide, and if I owned a home in Adelaide and I lived in that home, then I moved to Sydney for a job, then for 6 years I can keep that home and not have to pay tax on it. Because remember, if you own your home and you live on in that home, the amount of money that you make, for example, if it goes up in value, you don't have to pay tax on that. And that is a fantastic system that we have in Australia. Now, the only catch for the 6-year rule is if you then decide to buy a home and live in that home, that's when the previous home gets cancelled out. So you have to only have one home that you call your main residence. The tax law calls it the main residence exemption. So you have to only have one home that you live in to capture that 6-year. Sometimes people come and they think they can dodge the system and sort of go, okay, I've lived in this home and now I'm going to buy another home and live in that and I'm going to claim 6 years on that and no tax on this. That's not possible. You have to pick one. And
Mm.
usually what happens is the second one they buy is more expensive and is likely to go up more in value. So then they have to let go of the um,
Fin-
the exemption in the previous home. So, yeah, it's lots to think about. And then if you are moving out of your current home and you are, buying another one and to live in, and you're going to rent that one out, so you're changing your main residence, you also need to get a proper valuation report, and not a valuation report from your real estate agent, but from a quantitative surveyor who can tell you exactly how much your home values, so that when you go to sell it, you can deduct the portion that you lived in it, so you don't have to pay tax on that. And sometimes people forget to do that, and that ends up costing them a lot of money.
Yeah. Yeah, that's such a great tip. Um, okay. And yeah, so in summing up, is there anything that you would like to, like a few quick tips that
Yeah,
people
for
should remember?
sure. So I think keep records. Make sure
Yeah.
you upload everything on Google Drive. Make a folder. I know it sounds very accountant-like and very pedantic, but keep records, because how are you going to deduct the stamp duty if you don't know how much you paid for it?
Yeah.
So in 10 years' time, so you need to make sure that you keep all the records, and think about the end in mind when you're making such a big decision like purchasing a property. What do you want to do with it? Is this for a 5-year purpose, 10-year purpose? And then talk about or think about the structure that you want to put that property in. Um, and
Mm,
don't just rely on what someone says. Do thorough research, to be able to get the right outcome for yourself and for your self-interest.
yeah. Such great tips. Thank you so much, Alesha. And to everyone that's watching, if you would like to reach out to Alesha, I'll put her contact details in the description box. And yeah, and if you would like to know when our next podcast goes live, make sure you subscribe and give us a like, because that helps us out. But otherwise, thanks so much, Alesha, and I'll be looking forward to our next chat in the not too distant future.
Thanks for having me, Jem. Really appreciate it.
Okay, bye bye.
Bye.